Okay, good morning, guys. So we'll continue on discussing the neoliberal policies, and we're going to focus mainly on two main reform areas: trade liberalization and the promotion of foreign direct investment. And we're going to see why the region performed poorly with regard to the trade liberalization and attracting FDIs. So this is the layout. We're going to focus on like two main theoretical frameworks that assume or argue that trade liberalization would enhance and boost economic growth. One perspective focuses mainly on structural change theory of economic development, with the prime focus on the role of the state and internal dynamics, and the other one focus on international dynamics that would enhance the competition and would help emerging economies to carve out their own competitive edge or space in the global economy. So we're going like to focus on how FDI actually would have this multiplier effect on economic development and economic growth, and what are the key determinants of the FDI. And we have like two cases: the EU-Morocco regional trade agreements, and to what extent this helped Morocco to have or to develop, or to create its own competitive advantage or comparative advantage. And like that had supposedly would have repercussions on the overall economic performance. And with regard to FDI, what kind of records the region or the Arab countries achieved in order to attract international capital flows. And we will focus on the Gulf financialization and regional and international investment in the Gulf. So we have like the Gulf and the EU-Morocco relationship with regard to the trade liberalization and financialization politics. Okay? So give it a guess, like how international trade or liberalization of the trade or removing any kind of restrictions on trade would enhance economic growth. What are the mechanisms here? I hinted at this last lecture when we discussed the Washington Consensus and the reform package. We have like three main pillars here. The first thing, like by removing restrictions and opening up borders, for free trade transactions or trade flows, this would transform the productive base of the country. It will develop or create its a comparative advantage by encouraging the state to specialize in certain goods or in creating knowledge or making use of the excessive supply of labor or human capital or the intensive or the physical capital it has. So this competitiveness or the liberalization of the trade would transform this productive. This is, yeah. They are still waking up. Yeah, okay. So this actually will transform the productive base of the country or the state in order to develop its own comparative advantage in the global economy and specialize in products that would help it to create this comparative advantage. Like others would argue that this kind of like the liberalization of trade would offer incentives for firms to innovate in order to push down to have like a competitive edge with regard to the prices, because this would push down the prices, or innovation will help like to reduce the marginal cost and will help to reduce the cost of production and would diversify the products, and customers will buy it anyways because they are going to have like high quality products. Like for them, like liberalization and the expansion of the productive base would actually create job opportunities and would attract, different firms, to expand on the diversification or the composition of the productive base, and this would help like achieving sustainable economic growth and reducing the inequality rate. And for emerging economies, if they liberalize their trade and remove any restrictions on trade transactions, this would help them getting integrated into the global economy and attracting as well like foreign FDI or foreign firms to work in their countries in order to make use of the market size. So these are like the main assumptions of the two theoretical frameworks that we're the main theoretical angles that tackle, the positive impact of trade liberalization on the overall economic performance or the overall improvement of macroeconomic indicators. For structural change theory, this actually proponents argue that this will transform or to help the country to make this transition of the productive base and to enhance its own technological capacity in order to cope up with the fierce competition in the international market. But they focus on the proactive role of the state. So this, as it happened in East Asia, so the state had to play active and proactive role and in transforming, the productive base by helping or subsidizing some industries that have positive externalities and would have trickle down effect on other industrial activities or economic activities, and will actually encourage other development of other new industries by incubating foreign FDI or foreign direct investment or attracting foreign direct investment. So the central element here is how actually the state would encourage industrialization and diversify the industrial base of its own economic structure, as it happened with the Asian tigers when they have these kind of selective integration by offering some sort of protective measures for some nascent or infant industries, and they have some other well-designed industrial policies in order to attract FDI and to enable this transfer of technology in order to upgrade their own technological sector and to get integrated into the global market. So for proponents of this theoretical account, they actually pivot the focus away from this international dependency. It's away from this unequal exchanges between the North and the South, and they focus instead on the internal dynamics that would help the state to intervene efficiently in allocation of resources and accumulating capital. For proponents of international trade theory, they argue that like the increasing or the scale of the trade transactions or the increasing rate of trade volume, this would encourage or increase this international competitiveness by offering incentives for investment and specialization as well, like how to specialize in producing some products that will have like enable the country to develop its own comparative or competitive advantage in the international market. And this actually will help the state to invest in research and development in order to upgrade their own technological sector and to reduce the cost of the cost of production and to create more product or to improve the quality of the products in order to accumulate benefits. For them, like the scale and the intensity of the technological advancement or the easiness with which like information can get disseminated across borders, this would enable, you know, this kind of cheap communication and information, and would help emerging economies to make use of the new technological advancement by everything is available and everything cheap, so they are going to make use of it. But learning by like knowing how, it would be like through learning by doing. So the thing is, this will have like a spillover effect because they are going to make use of the free flow of the information, and they would improve or upgrade their technological sector or technological skills. So they will develop, you know, this kind of mastering technological advancement. The globalization or the new form of the globalization of the capital markets, it enabled, you know, different forms of financing investment, including like knowledge capital as well. So this enabled investment in different forms that would increase the competitiveness and would have positive impact on overall economic performance or all the economic sectors. Any reflection on these assumptions? So the first one, perhaps, like it's contingent on, as we mentioned, the role of the state, like efficient intervention of the state in order to enable, you know, this to make the most out of this kind of specialization and expanding industrial base and transforming the productive base. But like, do you have any take on the assumptions of the proponents of international trade theory? Is it conditional as well, like in order to produce these kind of positive impact on economic development or economic growth, is it contingent on other factors? Okay, we're going to discuss this further when we try to apply these theories why trade liberalization didn't bring about positive impact on the overall economic performance in the Middle Eastern countries. But like, let's discuss like the conceptual framework about like trade liberalization and what forms of trade liberalization. So we have like two main forms that are not mutually exclusive, like trading entities can engage in both forms simultaneously. So like the first form is inter-industry. So the point here is different countries, they have like different resource endowment, like some are resource rich, other are labor rich countries or labor abundant. So that's why specialization would have increasing returns for the overall, for the overall economic development, and would increase, you know, the trade flows. So the most prominent or the most famous model is Heckscher-Ohlin model here. Like the main assumptions here that two countries, they have like two different resource endowment. no one will specialize fully in producing one product, but they have like identical customer like taste and identical technological level. So if country is like so they have like, you know, different factors of production. For example, you know, one country would have like, you know, advanced technological sector in order to produce sophisticated products like electronics, and others, you know, the other country will have like it's rich when it comes to the labor force. So that's why it will develop some sort of a specialization or a comparative advantage with regard to labor intensive industries. So let's say like shoes, for example. So they don't need like, you know, these kind of high tech, they don't produce high tech products, and they don't need like these kind of capital intensive or technological advancement in order to produce electronic goods. So the comparative advantage will come or will emanate from this kind of factors of production. Like one of the assumptions as well, like, you know, there is a free move, you know, of these factors of production from like one sector or between industries in one countries rather than between countries, like inside one country between different industrial sectors rather than between countries. So that the comparative advantage here is the resources, like these kind of nations resources, or the resource endowment multiplied by the technology of production, meaning the intensity with which, you know, these kind of factors of production are used in order to produce certain goods. So this kind of so the state, like, so here, like, you know, like one state or state A will never be specialized in producing shoes or primary or elementary products, and state B will never get specialized or be specialized fully in producing computers or electronics or more sophisticated products. So what are the benefits here? Like there will be losers anyways, but according to this model, like the sum or the net effect of international trade or this kind of free move of products will have, like, you know, will exceed, you know, the sum of the losing, or the sum of the will exceed, you know, the losing impact or the cost of the losers. But it had, like, you know, some other negative effect as well. Any guess why? So domestically, this will push down the prices because of the excessive supply. Like if country A produces both, like elementary and sophisticated, and will getting, you know, more and getting more as well from country B. So this excessive supply of certain product will actually put down, you know, the prices in the domestic markets of country A. So losers in terms of capital owners in labor-intensive industries will lose because the state will subsidize imports or capital-intensive industries, and and labor as well, like, you know, labor-intensive industries in this country will lose because it will like reduce the wage rate in these countries as well. But the net effect, you know, of this kind of liberalization of the trade will have will exceed, you know, this kind of the losses of the losers, or the accumulation of losses on the part of the losers. So like the intra-industry, they export similar but differentiated products, like, you know, different brands, you know, of shoes, for example, or different brands of computers produce the same product but differentiated ones, both like elementary and sophisticated. This would enable, you know, the large scale productions, or enable economies of scale, and would diversify or offer variety in trade partners. So the market will have like different varieties of the certain product, and this would enable producers to improve the quality and to diversify the composition of these products. and overall, like this will improve like the efficiency with regard to the allocation of resources, and would improve, you know, the would enable firms to accumulate benefits, and would help like customers to have like a wide variety of products in order to make decisions about, you know, which one to go for. So this is the international trade and how international trade would actually overall improve, despite the fact that it will there will be some losers from liberalizing trade policies or liberalizing trade transactions. This will have like overall positive impact on the economic growth in different forms of trade transactions. For FDI, it will have like, you know, this kind of multiplier effect, because this would enable ratification or emergence of regional trade agreements by offering the increasing, you know, this kind of competitiveness of domestic sectors. This will help countries to attract foreign capital flows in order to get integrated into the global market. And FDI will help like modernize the industrial sector and increase the overall investment level in country A or in the hosting countries. And it will have like a spillover effect or diffusion impact of the like improving, you know, skills or like offering some sort of technical help and technical expertise that would help countries to enhance the skills capacity or building capacity of their own capacity, and to help to develop their own knowledge as well. But here again, like the overall positive impact of foreign FDI and international trade is contingent on other factors. Can you guess like what are these factors? They cannot what?
The independence of distribution is one of the factors.
So you need like some sort of institutional guarantees that would protect, you know, the like investors from a potential expropriation, or to protect, you know, against, you know, any kind of violation of copyrights. Yeah, so you need some sort of judicial institutions or regulations that would offer some guarantees for them to run their own business. Yeah, and which is questionable in much of the within, like, you know, the vast majority of the countries in the region. What else? What? Political stability. Yeah, but technically, like in order to enable, you know, this mastering of technological rigors and making use of or to learn by doing, so you need to have like high absorption capacity in order to make use of this kind of cheap flow of information or technological advancement that emanated from the new or the global capital economy. Like degree of complementarity between FDI or attracting foreign firms and domestic investment, because otherwise, if the domestic industries or investors, they cannot cope up with fierce competition. So FDI might have crowding out effect or stealing effect by pushing them out of the market or forcing them out of the market. Like the ability of the state in order to impose MNCs or foreign firms in order to transfer technology and in order to offer some sort of technical training or managerial training in order to enhance the capacity and the skills and the knowledge of the hosting country, and to what extent it will be like the cost of imitation. It might be costly for hosting countries to imitate, you know, to have like, you know, this kind of quality assurance or quality improvement units, to have like these kind of high-tech products. It might be like costly for them to imitate or to follow, you know, to follow in the same path or the same steps. So it's conditional, like some sort of conditions would enable, this kind of positive net effect of FDI or international trade on the local investment. So it's not like uniformly positive. It's contingent on some sort of internal dynamics, as I mentioned, the ability to absorb or the capacity to absorb, these technological advancement, the degree of complementarity between FDI and domestic investment, and the ability to transfer technology and to reduce the cost of imitation. Yeah.
What can be the the country has an influx of foreign direct investment?
Yeah, if they don't have like similar domestic investment, like similar investment in the same products, domestic ones will be pushed out. They will have to exit the market because they won't be able, to absorb, this kind of technological advancement. They don't have like this kind of efficient management. They don't have this quality assurance standards. So there won't be any kind of demands for their final products in comparison to the foreign ones.
If they don't have a similar production.
Yeah, if they don't have that's the thing. If they don't have, it's like what in the Middle East, for example, like what in the Middle East, like in financial sectors, they won't have any kind of negative impact. But
Get the point if they don't have a similar.
We are talking about the industrial sector. Okay, because again, there is kind of a bias, with regard to the whole point behind international trade or liberalization, or the liberalization of the trade transaction on attracting FDI, is to transform the productive base of the economy, your own economy, national economy, and to make these kind of structural changes in the national economy. Right, so it might have these kind of positive impact on sustainable economic growth. In order to have this, you need to have some sort of standards with regard to domestic industries or domestic economic sectors, in order to make use or to make the most out of this FDI, the free move or the capital inflows and the free trade movements. Okay.
But I agree with the point that. But if they don't have a similar, let us say, trade special, some will exit the market, the domestic producers, because if they don't have a similar.
Yeah, but we are going to highlight the case of Morocco in relation to the EU. But again, it didn't improve, it didn't help with this transforming or making, this transition with regard to the composition of the production, or the expanding the productive base towards, capital intensive industries. Okay, again, the conception of high economic growth is pretty much tied, to the rapid industrialization and or expanding, your industrial base, and attracting, FDI in order to upgrade your own economy and to improve the quality of the final products. Okay. So why foreign firms would locate their businesses or enterprises, to hosting countries or foreign affiliates? Any guess on the motives behind this? So first one, to make some sort of benefits out of the factor endowment, like cheap labor, for example, good institutional conditions that would provide them with tax exemption policies, and rapid establishment of their own enterprises, or free use of lands or other assets. So this would be for efficiency considerations. So they might invest, in foreign countries, and to get like the market size as well, in order to get access to big markets, in order to enable the absorption of the final products. So we have like two forms of FDI. Vertical one. So the vertical one, the foreign like foreign firms would locate input processing to foreign affiliates, and thereby creating this vertical chain of production. So the main motive behind this, or the whole purpose, is to reduce the overall cost of production by using these kind of lower trade costs, by getting access to import intermediate goods in this country or from neighboring countries, and lower wages for low skills workers, low corporate income taxes, like they are getting some sort of preferential treatment with regard to the taxation policies. So here, like trade and investment are complementing each other's in order to get like large market share and to invest in enhancing skills, and this would enable actually the hosting countries to improve their own skills, and to invest in R&D and in unskilled labor intensive stages. They will locate these kind of labor intensive stages in the chain of production in labor intensive countries that they don't need any kind of skilled labor force, and for other capital intensive and high-tech industries, this will be located in other countries, and this would enable them to develop their own skills and acquire more knowledge with regard to the know-how point. For the other form of the FDI is horizontal one. So they are firms actually tend to manufacture similar products at different places in order to reduce the trade costs associated with exports. So the whole point here is to create export platform in these countries, because these countries, they don't have either the big market with regard to the size of the market. They are not big enough in order to absorb the final products, or the cost of setting up their production facilities. It would be very hard or very high for them to establish or to set up their own business, their own enterprise or economic activities there. So, but they would make benefit out of this unrestricted access or exchanges of intermediate goods at all stages of the production, in order to manufacture this or to produce the final product in different countries. So here, trade and investment are substitutes. So they need to use these country in this kind of horizontal form of FDI as export platform. And it's efficient for them because they will use this country as to export some of the material for investment in final products or in final goods in other country, and they will invest in intermediate goods in internationally integrated countries. So they will make use of at this stage of production, they will make use or make benefit of intermediate goods in these countries in order to reduce the cost of production that is associated with the trade and export of these intermediate goods. Which form would be applicable or viable more for the Middle Eastern countries? Because obviously they are not part of the global the vertical chain of production that would enable this kind of making use of cheap labor or enabling this transfer of the technology. But they could have attracted some sort of foreign firms in order to use them as export platforms, right? Yeah.
Seems applicable to the Middle East because
for example, they can use these kind of automobile engine in order to produce the final product of the the car as a final product. So they produce this in this country and use it as export platform and export this to the other country that they have like larger market size and the purchasing capacity of the customers in this country. So because they don't have like market size or the taste of the customers, it's different, in these countries. So they only use this because like perhaps they can use, these kind of the materials or the composition that in order to produce intermediate goods are cheap in these countries, in this country, that would serve as an export platform for them. Yeah.
Also, do you think also vertical one? Because it's a way to, if we
cheap labor? Yeah.
From this view, we can say that as a like offer of like Turkey also.
Yeah, but they don't have. They are not like it's low skilled labor, but the wages are higher in comparison to East Asia. Yeah, so that's why it's not an attractive place for them, for to establish, their or to locate, the input processing, to them.
Last question: do you think it's cheaper
For them? Yeah. So they like for FDI, for them like this will have like multiplier effect because like it will help like increasing the level of the investment in the hosting countries, and it will help the hosting country to form new capital and accumulate improve the accumulate new human capital by increasing the skill level and knowledge level. And there should be like degree of complementarity between domestic and foreign FDI and local investment. So otherwise it will have like market stealing factor or crowding out effect. So for like economic term, like in order to have like high total factor productivity when it comes to FDI, so the hosting country there shouldn't be large technological gap between foreign and domestic firms. Otherwise, one will benefit more in comparison to the other. The absorption capacity to master the new and complex technologies, and to have like export promoting trade policies or trade regimes. Indirectly, like FDI will like enhance the efficiency and like the technology transfer in the hosting countries, and will help like the emerging economies or the hosting countries to get integrated into the world economy by having these kind of technical assistance to suppliers and customers, and demonstrating it will have like some sort of trickle down impact or effect on domestic firms by the choice of their own technology. There will help like or offer incentives for domestic and local investors to develop same export promoting behavior and to improve their managerial practices. So this is like theoretically speaking how FDI will have multiplier effect in order to improve, increase the productivity of certain country, and to have like sustainable impact, sustainable like effect on sustainable economic growth. But it's contingent again on some institutional factors, as you mentioned, like the efficiency or the effectiveness of government in order to offer some permissible or conducive regulations and regulatory framework and legal protection for foreign firms to run their or to do their own business in their countries, and to have like this business friendly environment with regard to the speed at which they can establish and run their own enterprises. And the corruption rate, the bureaucratic corruption, would actually increase the cost of setting up foreign business, because of like paying bribes or kickbacks would increase the cost of production, so they will refrain from locating their capital to high corrupt countries. And the overall economic performance is very essential for them in order to have like to locate or to their capital or their own enterprises or their kind of input processing, to these countries. They need like to have like, not high balance of payment deficit, and they should have like, some sort of extensive and like an advanced industrial sector size. And political conditions, political stability, needless to say, it's very essential for them to establish their own business. So for our case here, let's see how trade liberalization enabled Morocco to get integrated into the global economy and to develop, its own comparative advantage or specialization. So the EU, as I'm not sure if you know, like they have like, this kind of track records with regard to ratification of a series of association, Euromed association agreements with the MENA region in 1960s, in 1970s, throughout, like in 1960s, for example, they have this Euromed association agreement that enabled Mediterranean countries or some of the Arab countries to have like, they gave them or offer them free access to the European market, the EU market. And in 1970, with the Southern enlargement, they had, this kind of global Mediterranean policy in order to offer non-discriminatory trade concessions to the Euro-Mediterranean countries, including Spain and Portugal and some of the MENA region. And then like Barcelona process in 1995 that actually aimed at creating, this kind of Euromed free trade area. And this is the context within which Agadir Treaty was ratified in 2004, but it actually was entered into effect in 2007. So according to the HO model, like Hector all-in model here, both EU as an entity or as a country and Morocco, both they have like differentiated or different factors of production. Like one, they have like, different Morocco, like, they have like abundance when it comes to cheap labor and agricultural products. And the EU, they have like advantage or different in the intensity with which, the products or the sophisticated products are produced. It's primarily fall into the high-tech products or capital-intensive products. So according to this model, like neither Morocco nor the EU should be fully specialized in producing elementary or sophisticated products. But the trade, and with these kind of trade flows, this would enable them to specialize in certain products and to develop, their comparative advantage through this incomplete specialization. So Morocco mainly focused on agricultural and light manufactured goods that actually didn't enable it to make, a transition to capital intensive products. So eventually here, like if you see like here the difference between exports of vehicles to Morocco. So here it started to increase, after, the ratification of the treaty here, meaning like one exports, vehicles more than the other. And here, like the tomato, like the difference between Moroccan export of tomatoes to the EU and exports tomatoes, from the EU to Morocco. So they ended up like specializing, or exporting mainly agricultural products, and the other one exporting, or in this case, Morocco importing, vehicles from the European Union. So that's because of like insufficient absorption capacity. They didn't have like these kind of the domestic market or the domestic investors were ill prepared in order to absorb, these technological advancements, and they have like a low skilled or qualified workforce in order to produce, more vehicles to enter to have the capacity to produce more and to export more vehicles to the EU markets. And they don't have like, this kind of will establish local investment in heavy industries or heavy manufactured products. So they have as well resistance from some business people or some business association there. So the competitive advantage here was created with regard to the agri-food, they have light manufacturers, manufactured goods, mainly like textile and clothing, and they didn't develop, this capital-intensive and heavy manufactured products. And it didn't help, the treaty didn't help it, to make, this move or to transform the productive base towards exporting high-tech products. Any question here? Okay. So with regard to the FDI as well, the entire region behaved poorly to attract FDI. Any guess why? Because we mentioned the determinants of the FDI, the institutional and political and the economic ones. So for political considerations, mainly and high level of corruption, and the macroeconomic performance as well. So they don't have the misuse of the external funds, that actually they use external aid and foreign exchange in order to finance the balance of payment deficit. So they don't have when it comes to the consumption and investment, so they consume more than they produce or invest. And they rely heavily on international reserves in order to finance the deficit as well, rather than they don't have a high level or sustainable high rate of GDP in order to enable savings and investment. So the market as well, or the macroeconomic performance is very poor and is very shaky or tricky for foreign investment to locate their own businesses or to do business in these economic context. And the total factor productivity is very low because of the absence of the technological industries, or it's beyond economic effect because of this kind of cronyism, as we discussed last seminar. So there is kind of resistance or pushback against this kind of opening the market, for international competition. So the business people, they have stake in preserving or shielding their own market share, local market share, and pushing back against, opening or liberalizing the trade and attracting FDI. So here, the region in comparison to Latin America and Southern and East Asia. So here, the lion's share, they have the lion's share of attracting the FDI, East and Southern Asia, and relatively speaking, Latin America started to do well, and then this is the entire non-Gulf Arab states. They excluded because the Gulf attracted these kind of FDI, especially in the financial sector, banking and financial sector. So this is so the Gulf states started, to attract, these kind of foreign banks to allocate credit, but they don't have this kind of flexibility in order to allocate, credit in other countries. Any guess why? They started to do well, the commercial banks started, to play intermediate role between foreign firms and domestic investors. But anyway, any guess why the Gulf states failed to they attracted foreign banks, but they were unable to allocate credit in other regimes or in other countries? So first, they don't have these kind of sufficient facilities that would enable the bank to assess carefully the credit worthiness of of debtors. And the second, this kind of the ratio between low credit is very low, and it needs like high value of collateral in order to make to make these loans. So that's why the Gulf banks were unable to allocate some sort of credit to other regimes, but they started to play pivotal role in mediating the relationship between foreign firms in the international market, and the instead of lending directly to domestic investors, so they started to have to develop or to cultivate this direct relationship with the foreign firms, and they make or accumulate benefits out of the commissions and out of these kind of direct interaction with the foreign corporates or foreign firms. So they became like a player in the international market as well. This is what we are going to discuss more with the emergence of the sovereign wealth fund in the seminar, and how they actually started to make use of this excessive, supply of petrodollars, or the accumulation of the benefits that came from the oil sector, and they started to diversify their own economy by investing in foreign assets, having their own private equities, and attracting funds from different foreign investors, and reusing these kind of funds in different sectors like agricultural, health, education, pension, or this kind of liquidation effect. And then they tried to publicize or to abide by transparency by listing, themselves on the international stock market. So they started to financialize, and liquidate, other sectors that are essentially focus on non-liquid assets, or non-liquid that they don't have this kind of non-liquid orientation, as it happened with attracting these kind of funds and reallocating or these resources or these funds in different sectors in the region, as it happened in the funding some sort of agricultural investment in the Arab regions, and having some sort of investment in infrastructure and telecommunication and health sectors. But again, this created some sort of, despite the fact that the development of the financial sector in the Gulf and relocating of their own investment across the region is still the regional integration or the regional trade agreements not up to the high economic level, or didn't achieve this kind of, it didn't reach the level of getting integrated into the global economy, because of the politicization and of some issues, or these kind of economic transactions or economic relations are subject to trade boycott, border closure, for example, due to some sort of political disputes or over political disputes. So still it created some sort of interdependence between the Gulf and other Arab states or non-Gulf states, but it didn't reach the level of the trade and regional integration. And we will discuss this more. They had investment in agro-commodities and in infrastructure, and basically in agricultural sectors and food products. And in the Gulf states, or in the Gulf, they attracted mainly, or they performed well when it comes to attracting foreign banks or foreign financial players in order to relocate their business in these countries. And for foreign, asset management firms or sovereign wealth fund, we will discuss this more in the seminar, and we will discuss two more pieces on the determinants of international trade and determinants of DI, and why trade liberalization didn't enable, the other piece didn't enable Egypt to get integrated into the global economy as it assumed or expected by theories of international trade. Any question? Yes. For the seminar? Yeah, okay, yeah. Okay, we will build on this, like the determinants of FDI and the conditions of trade liberalization, and to what extent this will help like states to have high economic growth and why it didn't in the Middle East. Okay.
I think averages, sometimes. Yeah, that's true.
Yeah, if you have questions about the essays,
Oh, sure. I mean, I'm debating whether to do them